Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of ESG Investing Explained, a complete guide for 2024 investors. A complete guide to ESG investing for today's investors. Investing isn't just about profits anymore. More and more people want their money to align with their values. That's where environmental, social, and governance, ESG, investing comes in. This approach focuses on companies that are responsible and sustainable, attracting a growing number of investors who care about more than just the bottom line. As today's financial landscape shifts, ESG investing is gaining traction. Investors are demanding options that support social good, environmental sustainability, and ethical governance. In this video, we'll explore what ESG investing means, why it matters, and how you can get involved. Ready to make your investments count for more? Let's dive in. Understanding ESG investing. ESG investing considers 3 important factors: environmental, social, and governance. These criteria help investors decide not just based on financial returns but also on a company's impact on society and the planet. This approach appeals to those who want their investments to align with their values. Let's break down each component and see what it really means for investors and the world. What is environmental investing? Environmental investing focuses on how companies handle their impact on the planet. This includes how they manage resources and what steps they take to reduce pollution. Important factors to evaluate include carbon footprint, how much greenhouse gas a company emits. Lower emissions mean a positive mark in the environmental category. Waste management, the methods a company uses to handle waste. Effective recycling and minimizing waste contribute to better scores. Resource conservation, how well a company uses resources like water and energy. Efficient use and commitment to sustainable practices reflect well on their commitment to the environment. Investors look at these factors to determine if a company genuinely cares about the planet or just talks a good game. What is social investing? Social investing examines how companies treat their employees and communities. This includes several key criteria: labor practices, treating employees fairly and providing safe working conditions matter. Companies that prioritize worker rights score higher in this area. Product safety, ensuring that products are safe for consumers is crucial. A strong commitment to safety can make or break a company's reputation. Community engagement, companies that invest in their communities show they care about more than just profits. This can include charitable giving and community service. These social factors help investors choose companies that align with their ideals and make a positive difference in society. What is governance investing? Governance investing looks at how a company is directed and controlled. Good governance can mean better management and ethical practices. Important factors include corporate policies. Strong policies regarding ethics and compliance help protect shareholder interests. Board diversity. A diverse board leads to a variety of perspectives. This can enhance decision-making and reflect a commitment to inclusivity. Shareholder rights. Companies that respect and uphold shareholder rights show they focus on accountability and transparency. These governance factors help investors make informed decisions, ensuring their money supports ethical companies that prioritize integrity. Understanding these components of ESG investing empowers you as an investor. You can choose where to put your money in a way that reflects your values and supports a brighter future. The growth of ESG investing. ESG investing has seen a remarkable rise over the past few years, and understanding this trend is essential for anyone interested in finance and responsible investing. This section explores the current market trends and investor demand driving the growth of ESG investments. Market trends in ESG investing. The surge in ESG investing isn't a mere fad, it's a significant shift in how money is being allocated. As of 2023, ESG assets under management globally reached nearly $35 trillion, up from $22.8 trillion just 5 years prior. This growth of more than 50% highlights how seriously investors are taking environmental, social, and governance factors. A few compelling statistics capture this trend. Increased investment. By 2021, nearly 25% of all professionally managed assets in the United States were invested in ESG-focused funds. Record fund flows. In 2022 alone, ESG funds attracted over $21 billion in net inflows, showcasing investor confidence. Diverse sectors. ESG investing isn't limited to one industry. Funds in technology, healthcare, and renewable energy are growing faster than ever. These figures reflect a profound shift in investment behavior. Investors are not just looking for profits, they are choosing to support companies that align with their values and contribute positively to society. Investor demand for ESG products. So, what's driving the rising demand for ESG products? Understanding the reasons behind this trend can offer insights into future investment strategies. Social responsibility. Investors want to make a positive impact on the world. Choosing ESG products allows them to support causes they care about, from climate change to social justice. Strong performance. Studies show that ESG investments often outperform traditional investments. Many investors are realizing that sustainability leads to better long-term financial returns. Regulatory pressure. Governments worldwide are enforcing stricter regulations on corporate behavior. Investors feel that companies adhering to ESG principles are more likely to remain compliant and avoid costly penalties. Informed consumers. Today's consumers are more aware and concerned about how companies operate. They demand transparency and accountability. Investors are responding to this by directing their funds toward businesses that meet these expectations. The rise in ESG investing isn't just a trend, it's a meaningful transformation in the investment landscape. As awareness grows, investors of all kinds are looking for ways to align their portfolios with their ideals, creating a powerful force for change. Benefits of ESG investing. ESG investing brings a lot to the table, not only for investors but also for society as a whole. By focusing on environmental, social, and governance factors, investors can contribute to a better future while potentially boosting their financial returns. This section breaks down 3 key benefits of ESG investing. Risk mitigation. Investing based on ESG criteria can significantly reduce risks tied to various events. Take, for example, environmental disasters. Companies that prioritize sustainable practices are likely to face fewer regulatory fines and reputational damages. When a firm neglects its environmental impact, it risks facing legal actions and financial losses. Investing in companies with strong environmental standards can help shield your portfolio from these kinds of risks. Social unrest is another area where ESG investing shines. Businesses that support fair labor practices and diversity tend to have more stable workforces. A company that fails to respect its employees or the societies it operates in can face protests, negative publicity, and loss of customer loyalty. By investing in firms with good social practices, you can avoid these pitfalls. Lastly, governance failures, such as corruption or mismanagement, can lead to significant losses. When a company lacks transparency or accountability, it increases the odds of poor decision-making. ESG investments often emphasize strong governance practices, helping you invest in organizations with robust leadership and clear ethical standards. Long-term financial performance. Various studies indicate that ESG investments can outperform traditional investments over the long haul. Many people think ethical investing means sacrificing returns, but that's not the case. Research has shown that companies committed to ESG principles often do better financially. Why? Lower costs. Firms focused on sustainability may save money in the long run by reducing waste and improving efficiency. Attracting talent. Companies with strong social values are more likely to attract motivated employees, which can lead to higher productivity. Customer loyalty. Consumers today prefer brands that take a stand on social and environmental issues, resulting in better sales. By choosing ESG investments, you could be positioning your portfolio to outperform those that focus only on financial metrics. Positive impact on society. ESG investing goes beyond personal profit, it contributes to significant societal goals. Think about the pressing challenges we face today, such as climate change and social inequality. By investing in ESG-compliant companies, you help fuel innovations that tackle these issues head-on. Climate action. Many ESG-focused companies prioritize reducing their carbon footprint, which benefits the planet and public health. Equality. These investments often target firms that promote diversity and inclusion, creating a fairer workforce for everyone. Corporate responsibility. Companies that adhere to strong governance are more likely to act responsibly, benefiting not just their shareholders, but their communities as well. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.